There's a lot of noise in the market right now, so welcome back. I hope you're doing well wherever you're watching from. If you've been following this channel for a while, you already know we don't chase daily price moves here. We focus on structure, cycles, and how capital actually behaves when sentiment shifts. And that's exactly what we're going to break down today, because there's a reason this market feels frustrating right now, and it has nothing to do with intelligence or conviction. It has everything to do with contrast. When you look across global markets, you're seeing gold, silver, and even platinum pushing into historic territory. Charts that most people ignored for years are suddenly going vertical. Meanwhile, crypto looks flat, dull, and borderline lifeless. That contrast is jarring, and it's creating the wrong conclusions in a lot of people's minds. For most investors, price movement equals validation. If something is moving, it must be right. If something is stagnant, it must be wrong. That instinct is deeply human, but it's also deeply misleading. Markets don't move in unison, and they certainly don't reward attention evenly. What you're witnessing right now isn't crypto failing, it's crypto being ignored, and those two things are not the same. Historically, moments where one asset class is stealing all the oxygen while another looks dead are where people make their biggest mistakes. Attention doesn't flow to what's early, it flows to what's already moving. Gold breaking new highs feels safe because it's being confirmed by price. Silver going parabolic feels obvious in hindsight, even though it spent nearly a decade doing nothing. Crypto, by comparison, feels disappointing because it's not giving anyone immediate feedback. That disappointment is dangerous because it pushes people to start rewriting narratives based purely on emotion. You hear it everywhere right now. Crypto is broken. Bitcoin is done. Nothing is happening. None of those statements are rooted in structure. They're rooted in boredom. And boredom is one of the most powerful forces in markets because it convinces people to abandon positions right before attention rotates back. What makes this moment especially confusing is that commodities pumping is usually associated with fear, recession, crisis, systemic stress. So the natural assumption is that something bad must be coming, a black swan, a collapse, a reset. But that assumption is borrowed from past cycles, not guaranteed by the present one. Markets don't repeat mechanically, they rhyme, and sometimes the rhyme surprises people. There's another possibility that most aren't considering. What if these commodity moves aren't signaling collapse, but transition? What if capital is repositioning in anticipation of structural change rather than systemic failure? That distinction matters because it completely changes how you interpret what comes next. A crash narrative leads to defensive thinking. A transition narrative leads to rotation. And rotation is the one thing most retail investors consistently misread. When capital rotates, it doesn't announce itself. It doesn't move everywhere at once. It concentrates, it exhausts, and then it shifts. Assets that are flying feel untouchable right up until they stop. Assets that feel dead feel that way because no one is paying attention to them, not because nothing is happening underneath. Right now, crypto sits squarely in that second category. Engagement is low, sentiment is weak, price action is boring. That combination feels awful, but it's also familiar. This is what markets look like when conviction has been drained and attention has moved elsewhere. It's not the moment people talk about later. It's the moment they forget. The key mistake people make at times like this is assuming that what's performing today will continue performing tomorrow, and what's lagging today must be structurally broken. Markets don't work that way. They move in phases, not straight lines. And the phase where something feels ignored is often the phase right before it starts to matter again. So before jumping to conclusions about crypto's future or rewriting long-term theses because price isn't cooperating, it's important to step back and ask a different question. Is this underperformance a sign of failure, or is it a sign of rotation not yet complete? In the moving forward, we're going to move beyond price charts entirely and look at what actually drives these rotations. Macro conditions, liquidity shifts, and why commodities running doesn't automatically mean crypto is finished. What actually drives these rotations isn't excitement or headlines. It's liquidity, policy direction, and risk appetite, and those forces don't move at the speed social media expects. This is where most retail investors lose the plot because they assume that when one asset class starts running, another one must already be finished. In reality, markets rotate in layers, not switches. When you see commodities like gold, silver, and platinum moving first, that usually tells you one thing: capital is seeking protection, not growth. These are not get-rich assets. They are don't-get-poorer assets. Money moves there when confidence in fiat stability, monetary discipline, or long-term purchasing power starts to weaken. That's not bullish or bearish by itself. It's defensive positioning, and that's an important distinction. Defensive positioning does not mean investors are done taking risk forever. It means they are parking capital while waiting for clarity. Commodities tend to move early in that process because they don't require optimism. They require caution. Crypto, on the other hand, requires confidence. It needs liquidity, narrative alignment, and belief that the next phase has begun. This is why crypto often lags when commodities are surging. Not because crypto is broken, but because the market isn't ready to re-embrace risk yet. Liquidity doesn't flood back into speculative or growth assets until the macro environment stabilizes enough for people to believe that downside is limited. Until then, capital hides. That's also why rate cuts are so often misunderstood. People hear rate cuts and immediately assume bullish outcomes. But early rate cuts usually happen because something is wrong, not because everything is fixed. Cutting rates while inflation pressures still exist is not a green light for risk. It's a warning sign that policymakers are trying to manage stress without triggering panic. Markets feel that tension before headlines do. So when you see gold and silver surging while crypto stagnates, the correct takeaway isn't crypto is dead. The correct takeaway is that we're still in a transition phase. Capital hasn't decided it's safe to rotate yet. It's watching, waiting, measuring. And here's where psychology comes into play. Retail investors tend to chase what's already moving and abandon what isn't. That behavior is exactly why rotations feel sudden in hindsight. By the time everyone notices that money has left commodities and moved back into growth assets, the move is already well underway. This is also why boredom is such a powerful signal. When an asset class becomes uninteresting, engagement collapses and confidence fades. That's usually because speculative participants have already left. What remains is quiet positioning. That's not exciting to watch, but it's how foundations are built. Crypto is currently sitting in that uncomfortable middle ground, not euphoric, not collapsed, just ignored. And that's precisely why comparing it to commodities at this stage is misleading. They're serving different purposes right now. One is absorbing fear, the other is waiting for confidence to return. So instead of asking why crypto isn't following gold higher, the better question is this: what conditions need to change for capital to move from protection back into growth? Because when that shift happens, it doesn't announce itself. It shows up first in liquidity flows, not headlines. In the moving forward, we're going to talk about why this period feels especially difficult for crypto investors, the psychological damage, the lack of retail participation, and why markets often look the weakest right before they stop being ignored. This phase feels especially difficult for crypto investors because it attacks psychology, not logic. There's no dramatic crash to point to, no clear enemy, no single event to blame. Instead, there's something far more uncomfortable: silence. Price isn't rewarding patience. Engagement is fading. Even people who used to be loud supporters are stepping back. And for most participants, that's harder to endure than volatility. Markets don't just transfer wealth, they test conviction. And the way they do that isn't always through fear. Sometimes it's through boredom. When nothing happens for long enough, people start questioning everything. They scroll past charts instead of watching them. They stop checking wallets, they disengage. That's not random. That's how speculative excess gets drained without fireworks. This is why crypto looks dead right now. Not because the thesis collapsed, but because retail participation has largely checked out. Retail is the momentum engine of this market, and when that engine shuts off, price action becomes sluggish. Liquidity thins, volatility compresses, everything feels heavy. But that doesn't mean the system underneath has stopped evolving. In fact, this is usually when the most important groundwork is laid. While retail loses interest, longer-term capital pays attention, not to charts, but to infrastructure, regulation, custody, and settlement frameworks. This is the part of the cycle that never trends on social media because it doesn't offer instant gratification. It offers delayed relevance. This is also why bearish narratives feel so dominant right now. When participation drops, the loudest voices are often the most extreme ones. It becomes easy to say crypto is finished, that Bitcoin is broken, that the whole space was a mistake. Those statements spread not because they're accurate, but because they resonate with exhaustion. People don't share them to inform, they share them to validate how they feel. And here's the irony. Historically, the moments when belief is weakest are rarely the moments when structure is weakest. They're the moments when attention has already left. By the time confidence visibly returns, price usually moves first. And the same people who walked away start asking what they missed. Another psychological trap during this phase is comparison. People look at commodities, equities, or other asset classes making new highs and assume they chose wrong. That regret fuels rotation at exactly the wrong time. Capital chases confirmation, not opportunity. And confirmation almost always arrives late. This doesn't mean crypto must move tomorrow. It doesn't mean a rally is guaranteed. But it does mean that sentiment alone is a terrible indicator of long-term outcomes. Markets don't reward consensus thinking. They reward positioning ahead of consensus. Right now, crypto is being treated as irrelevant. That's not bullish by itself, but it's revealing. Relevance doesn't disappear permanently in cycles. It goes dormant. And dormancy is how markets reset expectations. In the move forwards, we're going to step back and look at how these rotations have played out before, why capital often leaves one asset class at the peak of attention and quietly returns to another when nobody is watching, and how liquidity, not headlines, determines when that shift actually begins. If you want to understand what happens next, you have to stop looking at price first and start looking at liquidity. Price is a reaction. Liquidity is the cause. Every major rotation you've ever seen in markets followed the same sequence. Capital concentrates, exhausts, pauses, and then redeploys. By the time price reflects that redeployment, the opportunity has already passed for most people. This is why watching gold, silver, and equities alone won't tell you when crypto is ready. Those assets are showing you where money has been, not where it's going next. When commodities run hard, it often signals that capital has already crowded into protection. At some point, protection stops offering new upside. That's when investors begin scanning for asymmetric return again. Not because they feel confident, but because they feel constrained. Crypto historically benefits from that exact moment, not when fear peaks and not when euphoria returns, but when capital quietly looks for the next outlet. That's when liquidity starts creeping back in, often invisibly at first. Volumes stabilize, volatility compresses, price stops making new lows, even though sentiment remains terrible. To most people, it looks like nothing is happening. In reality, something very specific is happening. Downside risk is being absorbed. This is where macro conditions matter more than narratives. As liquidity improves, whether through rate adjustments, balance sheet expansion, or easing financial stress, capital doesn't immediately flood into the riskiest assets. It tests the water, it reallocates in stages. Crypto is almost always one of the last places that capital returns because it carries reputational and volatility risk. But when it does return, it tends to do so aggressively. That's why the idea that Bitcoin is finished or crypto is broken tends to surface right before structural stabilization, not because critics suddenly become insightful, but because they're reacting to price rather than flow. Markets don't reverse when everyone agrees they should. They reverse when sellers run out, not when buyers show up loudly. Another key point that gets missed is timing fatigue. Long consolidations wear people down. They create a sense that opportunity cost is permanent. But if you look back historically, the most violent expansions tend to follow the longest compressions. Energy doesn't disappear, it stores. And when release comes, it doesn't ask for permission. Right now, crypto is doing something very specific. It's refusing to collapse despite sustained negativity, low engagement, and weak momentum. That alone tells you that forced selling has largely passed. What remains is optionality, and optionality becomes valuable when conditions change, not before. The mistake most people make here is assuming they need certainty to stay positioned. Certainty comes after the move, not before it. By the time it feels safe, the asymmetry is gone. Markets don't reward comfort, they reward preparation. The mistake most people make when thinking about what comes next is assuming it has to look dramatic. A crash, a pivot, a headline so obvious that everyone understands it at the same time. That almost never happens. Market environments don't flip with announcements, they flip with necessity. When the current positioning stops working, capital is forced to move, whether people are ready for it or not. If commodities are absorbing fear and crypto is being ignored, the eventual trigger isn't hype returning overnight. It's pressure building elsewhere. Protection trades eventually overcrowd. Returns compress. Risk-free assets stop feeling rewarding. And once that happens, capital doesn't ask whether crypto is comfortable or popular. It asks where asymmetric upside still exists. That's where the idea of a white swan matters. Not a disaster, not a panic, but a structural unlock. It could be regulatory clarity. It could be liquidity normalization. It could be institutional adoption, reaching a point where participation is no longer optional. It could even be something boring, like settlement infrastructure quietly going live at scale. None of those events look exciting in the moment. They look obvious afterward. And that's the uncomfortable truth. The next phase won't arrive in a way that makes everyone feel good about missing it. It will arrive when sentiment is still divided, when skepticism is still loud, and when most people are still anchored to recent disappointment. That's how transitions work. They don't reward those waiting for emotional confirmation. This is also why comparing crypto to commodities right now misses the point. Commodities protect purchasing power. Crypto, if it succeeds, restructures value movement. Those are different roles activated at different times. One does well when fear dominates, the other does well when systems evolve. Both can be true in the same cycle, just not simultaneously. So the real question going into 2026 isn't whether crypto will catch up tomorrow. It's whether the structural conditions that suppressed participation are slowly reversing. Liquidity, policy, infrastructure. Those forces don't move in straight lines, but they do leave footprints. And right now, the footprint isn't collapse, it's compression. Compression frustrates people because it offers no feedback, no dopamine, no validation. But compression is what allows repricing when conditions shift. Without it, rallies fail. With it, moves tend to be faster and less forgiving. This is where discipline matters, not blind optimism, not emotional pessimism. Discipline means staying aware without becoming reactive. It means understanding that markets spend more time preparing than rewarding. And it means accepting that being early often feels identical to being wrong, right up until it doesn't. As always, none of this is financial advice. Markets are uncertain, crypto is volatile, and outcomes are never guaranteed. Do your own research. Question every assumption, including the ones that feel most comfortable. Manage your risk. Decide what you're actually positioned for, not what you hope will happen. If there's one thing to take away from this entire discussion, it's this. Rotations don't begin when confidence returns. They begin when apathy peaks. And right now, apathy is everywhere. That's usually when markets start writing their next chapter. I'll see you in the next one.